Awesome. Hi, everyone. We're going to give this a minute and let people trickle in, and then we'll get started. All right. Looks like we have people coming in. I'll go ahead and get started. Thank you for joining our webinar today. We are going to be doing a deep dive into strategic reserves planning with our very own Lauren McDavid-Victor. She's one of our directors of finance here. Just a quick intro on Strut. We partner with venture capital firms on investor relations, fractional finance, operations, and events. We are both a strategic advisor as well as a day-to-day executor with you in the trenches. Couple quick things before we dive in. Let me get uh, as a reminder, this call will be recorded. We will share this post-event with everyone who registered, so not to worry. If you missed something or you want to go back and review it, we will be sharing it. There's a lot of content today, and it can get pretty technical, and I know you may have questions throughout the webinar, so feel free to post those in the chat box or the Q&A box, and we will do our best to answer those live. So with that, I'm going to pass it off to Lauren to introduce herself and get started.
Thanks, Nicole. Hi, everyone. Happy Thursday. My name is Lauren McDavid-Victor. I have been with Strut for almost 2 years now. Prior to that, I spent about 3.5 years in public accounting, started my career at KPMG on the audit practice, and then kind of migrated into industry. I worked at a software startup in Denver for about a year, and then got bit via the VC bug. I worked in fund admin for about 6 years before making the switch over to Strut. Great. So here is a quick outline of what we'll be covering today as like a quick preview. We will talk through reserves planning specifically and kind of framing it up as it relates to like the broader theme of fund modeling and planning as well. So let's go ahead and dive right in. To frame up talking through reserves planning for VC funds, we should define what the purpose of reserves are, which is essentially setting aside enough capital after the initial investments and expense allocation in a fund to participate in future rounds of existing portfolio companies, i.e. your winners. Reserves planning can help ensure that the fund can support its winners in later rounds and avoid excessive dilution, which I know is kind of a hot topic these days. And it is a good opportunity to assess your fund's thesis and strategy at any stage in your fund's life. A couple of other noteworthy items on reserves planning. The need for your firm might differ from some of your peers, especially depending on conditions like what stage you invest in, your fund's size, and sector norms. As we know, these things evolve over time. And I will try to keep this relatively high level to make sure that it is applicable to everyone on this call. But please do feel free, as Nicole already shared, to reach out to me if you have any like individual questions surrounding your fund's specificities. So let's start with talking about your fund's capital allocation model and how we should be thinking about initial versus reserve splits and reserving by portfolio company. To frame up this conversation, you can think of your fund's capital allocation as the financial blueprint that lays out how the fund's committed capital will be deployed over time across the initial investments, your expenses, and your follow-on investments. So those follow-on investments are obviously commonly referred to as reserves, so you might hear me use those synonymously. This is a key component of fund modeling and portfolio construction and allows you to help prove out your fund thesis and allow you to track performance against what you set out to do in case you do need to pivot along the way. So regardless of where you are at in your fund's life, it is good to take a look at kind of that fund thesis against where you're trending currently. So speaking on the quantitative side of the framework here, there should be an initial allocation for investments and follow-ons from the start. So you should consider the differing needs based on your stage of investing and the overall portfolio construction strategy. You can see here that I've listed on the slides a couple of examples and trends that we often see based on those differing components. And as an example, there tends to be a smaller initial investment allocation for firms that invest in Series A plus companies, as the follow-on needs tend to be typically higher and heftier. There are some other factors to consider here as well, outside of stage and number of portfolio companies. One is understanding how highly you regard doubling down on your strong investments through a follow-on strategy. Two, your risk appetite, and three, your overall fund size. To pull this all together, my pro tip here is to actually create tiers based on portfolio company potential to help guide that decision making. If your fund is early on and it's difficult to assess company potential, or if you've not fully deployed your initial investment allocation, I would use market comps or benchmarks for firms of similar size and strategy to assess what a reasonable reserves allocation would be. We have already hit a little bit on forecasting and modeling, but let's dig in a bit more here on the quantitative side. First and foremost, I want to say that I think a fund model is helpful during the fundraising period and during the fund's life, assuming that you do review it against fund actual performance during the fund's life. I commonly get asked about fund models in general, and so I think it's only a great tool if you are going to utilize it on a recurring basis. You should be thinking of the fund model as your North Star, as it should be reflective of your fund's overall strategy and thesis, and it should be a mechanism for basically proving out that overall thesis. That being said, it is not uncommon, especially in the current environment, to need to pivot. So if the market conditions are demanding that, I encourage you not to shy away from the new opportunities just because they may not perfectly align with the initial strategy. A lot can change in more than 10 years. So I'm not going to go super deep on modeling and forecasting because I could quite literally keep you here all day. But the fundamentals of a good fund model do include the total number of companies you ideally want to invest in, the average and maximum check sizes, round progression assumptions and timing, and assumed exit timelines and outcomes. As we all know, these are difficult to predict. So you really are taking your best guess on market and benchmarks, or using your prior fund's performance to help guide that. You should also be estimating expenses through the life of the fund to have a full picture on how much investable capital you really have as a whole. Many funds do fall in that 20 to 30% range. So as you're modeling this out, if you're thinking, wow, that looks really high, it's not uncommon. So just wanted to flag that for you there. We actually did a webinar last year on budgeting for expenses. And so if you want some more information on that, please do feel free to reach out to me on that. Once you have established your initial model, I encourage you to toggle and play with different market conditions and varying capital needs. As I mentioned earlier, a lot can happen in a decade. And so knowing what pivoting might look like or what those plans B and C might be is helpful for you to have in the back of your mind. And a few areas specifically to stress test your model would be, next slide, thanks, Nicole. Ownership targets, round valuation inflation, exit sizes, and portfolio attrition rates. Okay, so now pivoting to the qualitative side, we've covered the quantitative. Successful VC funds don't all have amazing metrics just because they ran a tight math game on the model side. So there is a lot of emotions, gut feelings, judgment calls that bake into a GP's secret sauce, as we like to call it, when they start deploying capital. That being said, I do recommend you review your initial fund model quarterly and assess if you are on track or do need to pivot within a few key areas. KPIs for your portfolio companies based on industry norms and your firm's goal around investing in companies of certain performance. ARR might be a great metric to track, but that also doesn't make sense for all sectors. Competitive dynamics within the market, the overall fundraising environment, and other factors affecting the sector that the fund invests in. If this aligns with your strategy, utilizing a reserves or investment committee can be helpful in holding you true to your North Star and the overall goals of the fund. Sometimes I see those put in place and they are extremely helpful in just making sure that you're on track. Otherwise, great, just self-accountability and internal team dynamics can really get you there. One tool that I really like to see within the venture capital firms that I work with is the use of scorecards on a quarterly basis. It does help you tool and utilize keeping a strong pulse on the portfolio company performance to help determine whether they will receive a portion of the reserves allocation in the form of a follow-on. And so I did list a couple of those structured scorecard metrics that you might want to use if you're going to go that route. And now the last few pieces of key fund modeling considerations. You want to ensure that you're building out a capital call schedule that aligns with your planned deployment and reserves needs. Many LPs do like to know the approximate cadence of these capital calls, so this is helpful during the fundraising process. But it also can be helpful as you're just building strong rapport with your LPs. So the next component is the documentation of how you want to implement this strategy. So spending the time to sit down and write the form of a policy of what that reserves allocation strategy might look like and approval process is a great guideline for reallocating, unused reserves or recycling. All of those components are really helpful to help hold the fund true to what its overall goals are. In terms of tools, there are several ways to slice the cake, and it's not necessarily one size fits all in terms of the right solution. What is important here is that you are monitoring the reserve status and tracking your follow-on investments. I recommend staying really close to your portfolio companies if that's not the dynamic you currently have, so that you can maintain proper visibility into their overall health in the fund cycle. Plus, those key metrics are really helpful if you are subject to an audit for your fund. Switching back to something that I said earlier regarding the need to sometimes have to pivot, let's talk about some circumstances that we often see in terms of updated strategy. So one of the things that I hear a lot from my GPs is, hey, I'm concerned about over or under reserving, for follow-on investments. So while over reserving can result in missed opportunities for initial checks or unused capital, you can run the risk of not being able to follow on with a winner or experience notable dilution if you under reserve. So it's really more of an art than a science, and I like to view it as sort of a dance between the two. While you can have a strong fund model and plan for how you want to deploy those initial investments, we all know that average check size or ownership doesn't always flush out to what actually happens, especially if you're super excited about a portfolio company. So my key takeaway here is to split the difference. Don't be too aggressive, but also don't shy away from good opportunities as they present themselves. So most LPs will not come banging down your door if you didn't stick to the exact fund model that they saw during the fundraising period, especially if they're receiving great returns. I do also like to highlight that risk appetite of GPs also evolves as the fund matures. So most GPs are pretty conservative in the early years and a little bit more aggressive in those middle ground years. As the fund does continue to age, the thought is kind of about preserving DPI and managing the exit timelines. That tends to be more of the name of the game. So just because your risk appetite is low, maybe in the early years of the fund, doesn't mean that that won't evolve over time. As I mentioned a couple of slides back, I wouldn't shy away from good opportunities as they present themselves. A portion of your reserves should be actually opportunistic based. After all, statistically, not all of your portfolio companies will be winners, so it doesn't really make sense to allocate reserves to all of your investments right off the bat. If your LPA does allow for recycling, I would spend some time digging into that provision and assessing your risk appetite. I'm also not going to go super deep into recycling here, but I have seen this fall a little bit more out of favor in the last few years, as there are risks in not being able to meet the fund's expense needs, especially management fees. That may result in you having to defer them. And especially if you are a young VC, that can be difficult to float from a firm building perspective. Again, happy to talk more in detail about recycling if anyone wants to dive deeper on that. In terms of reserves and follow-on opportunities, LPs really appreciate consistent, timely, and transparent communication. There is not a standard format of LP communication styles that I recommend to GPs to deploy, and I really would consider sharing with your LPs your overall initial versus follow-on strategy so that they understand how the fund might trend as it ages. I also think that kind of sharing general deployment timelines is helpful, and then any other color you can provide around why you make the follow-up decisions that you do. I often see that these are incorporated into, quarterly LP letters, or if you do like in-person meetings with your LPs, that these are often discussion points. I also recommend that you educate your LPs as needed on how your reserves planning is utilized in order to drive the fund performance. Some LPs may not care. They may not fully grasp what you're talking about. So I think for a lot of institutional LPs, this might be an area that I would open dialogue for. I would talk about how you're thinking about allocating reserves and avoiding obviously doubling down on weak performers, and then any contextual market data that you have that helps drive that decision making. As I previously mentioned, revisiting your reserve strategy and allocation on a quarterly basis is a great first step. Using your fund model, your reserve strategy policy, portfolio company scorecards, etc., as a guiding light will allow you to be nimble and change course if needed. Focusing on the breakout performers and being willing to reallocate reserves previously held for stagnant companies is also a really strong strategy. We should be using dilution impacts and the return on your investment to help determine capital efficiency by portfolio company when thinking through that evolving strategy as well. In terms of leveraging data for your decision making or just general LP educational purposes, using tools like a pitch book or other benchmarking reports in the industry can help inform decision making on your strategy as well. If you have prior existing funds, using those fund strategies and performance to help guide your reserves planning for the current fund is a really great place to start. After all, the best prediction of future behavior is past behavior. So even though markets continue to evolve in other sectors, kind of keeping that in mind is definitely a great best practice. You may also note some key takeaways from prior funds, especially as markets shift. Like perhaps there is a changing market appetite for a portfolio company's offerings. So utilizing those learnings along the way to help basically frame up both the qualitative and the quantitative pieces is an important perspective. Like I previously mentioned, studying top performers that align with your fund strategy is also a really great learning opportunity. Benchmarking against their follow-on investment percentages, ownership retention, and exit multiples can help you frame how your fund is and will perform in the broader landscape. I previously shared some of these portfolio management company softwares earlier in the presentation, but Tactic can be a great fund modeling tool if you would prefer to keep it outside of a spreadsheet. The one caveat I do have to that software is that it's pretty involved. And so there's a lot of inputs and then output assumptions based on those inputs. So if you want to have more control over basically how the calculation is flowing through your fund model, I would recommend going a more manual route via a spreadsheet or Excel. Your portfolio management company software or portfolio management software also does not need to include fund modeling capabilities necessarily. There are a lot of platforms out there that help you track portfolio company performance, KPIs, updates, etc. Standard Metrics, Totem, and Omni are ones that I typically see the most. So bringing this kind of all full circle here, reserves planning and your fund thesis should be part of the continuous feedback loops, likely on a quarterly or at the bare minimum biannually basis. As the fund matures and markets evolve, being aware of your current status against your peers and keeping your ear to the ground will allow you to be flexible and toggle any changes or pivots you might need to make sure that you are optimizing fund performance and returns. Great. I know that was a lot of meat and potatoes. So any questions that I can help answer? Oh, Nicole, I think you're muted.
Sorry. We have one question in the Q&A box from Jennifer. Do you know of any good Excel templates for fund modeling?
That's a great question. We actually have one built here at Strut that we have iterated many, many times on. Happy to chat through that with you. Again, so much of fund modeling in general has to be specific to the fund. So yes, I think a template can be a great place to start, but I think maybe we should chat through that and just make sure that we're covering all of your bases.
Any other questions? I'll give it just another moment.
Okay, I see Landon shared in the chat. How do you think about adjusting reserves in a climate when mini rounds are insider led? So I think for me, I would be thinking about first and foremost, like how much promise does this portfolio company have? Like, do you really believe in them? Are you boots on the ground with them? I think those are like the qualitative components of, thinking through reserve strategy that you sometimes can't put like an actual number on. A lot of rounds have been insider led over the last couple of years. That's definitely been kind of just a general trend in the space. So I wouldn't necessarily say that because they've only been insider led that you shouldn't also follow on with them. But again, I think it is just like an overall assessment of, how are they tracking against what they set out to do? Does this continue to align with our fund strategy? And then ultimately, three, do you believe in them?
We have a couple more in the Q&A box from Dave. What happens if we fall off our plan and need to adjust?
I mean, great question. There's a lot of things that can happen if you fall off plan, but I think to the point that I made earlier, especially if your fund is early on, like in the first few years, still within the best investment period, I would say overall, you should be kind of thinking through the what ifs scenarios and playing with what those numbers might look like. Um, it's not uncommon to have to adjust. I would say a good portion of the clients that I work with do have some sort of pivot in their strategy as things evolve, especially like in the AI space, things are ever changing and changing quickly. So I don't really think that just because you're not on plan doesn't mean that your fund can't perform well.
Another one from Jennifer. How should you think through timing? For example, some of our companies raise quickly and others take longer, but this isn't always reflective of opportunity. Rules of thumb on how to make the decision in the moment of a follow-on round.
Mm. That's a good one. Yeah, I think when you're kind of putting together your overall reserve strategy and fund model in general, you kind of have to make assumptions based on the market standards for, how quickly they're raising or other conditions that might occur. So I think ultimately, I don't have a good rule of thumb for each sector, especially not for generalists funds. Like it just is ever evolving. But I would definitely say using those scorecards when it comes down to a game time decision can be helpful and trying to keep the emotion out of it too. I know it's hard because there's some portfolio companies we just love and absolutely believe in, but maybe the numbers don't substantiate that kind of emotional investment. So being able to play with both like the emotional part, like, hey, I really believe in them, but then also looking at like a scorecard or those metrics to help guide that decision can make sure that you're splitting the difference on not being too emotional about something.
Awesome. From Stephanie, can you share more detail about what to consider in the last few years of the fund's life, apart from expenses? What type of strategies can we consider for DPI preservation?
Sure. I mean, first and foremost, like keeping a really good pulse on the portfolio companies that are still alive, I think is important. Staying in contact with them, understanding when exit opportunities might occur. I have seen secondaries become increasingly popular as an exit strategy over the last couple of years. And sometimes those just appear really quickly, but those are great opportunities to generate DPI for your LPs. So not everything is going to go to IPO or go through an M&A. So understanding, hey, there might be an opportunity to just sell this to another party. That is, I think, a great opportunity to just be aware of what is going on in the market overall and helping really drive that DPI.
From Anne, what is the difference between Tactic and other products like Totem?
So I would say Tactic is a much stronger fund modeling tool in general. I mean, is a very nimble platform in the sense that you can scenario plan. So you can create a fund model and then literally copy and paste it and then reiterate on it. So that piece of it is pretty neat. Totem is more of what I would consider like a portfolio management software. So Omni adjacent. Um, the one thing that I really like actually about Totem versus Omni is that you actually can really control what those valuations look like and you can play around with it within the system. Whereas Omni really wants to drive off investment documents and there isn't as much flexibility in that platform. Totem is kind of up and coming. I have a couple of clients currently using them. So if you want to chat more about that, let me know.
Yes. Okay, we have a bunch coming in. Let me see. Okay, from Suzanne. I know the goal is to invest 100% plus of the fund, i.e., be able to invest capital that was used for fees and expenses, but how often does that typically happen in real life? Like, is
That's a
there
good
an
question.
industry, yeah, average of seed funds typically invest 90%, et cetera?
I don't have specific metrics right off the bat. I can speak from perspective of like the clients that I work with. I am more so like if you're really investing 100% of your committed capital, there is, a risk associated with over deploying just because, you're still going to have probably 20 to 30% of committed capital for expenses. So I usually see recycling happen more often with VC firms that have multiple funds. And this also comes from like a firm building and the need for management fees perspective too. Like if you have a $10 million fund one, you're probably not going to want to defer any management fees and like really push the investment component too hard because you're going to be really needing that cash for firm building. But in instances where you're on like funds 3, 4, 5, I will sometimes see, maxing out that investable capital, even considering recycling. But I kind of mentioned this earlier. I haven't seen recycling be as prevalent in the last couple of years. I think overall, just what's happening in terms of like investment opportunities and just the kind of difficult fundraising periods, I think make GPs a little bit more risk averse and don't want to necessarily bank on, hey, I'm raising fund four, I'm going to close $100 million on that and have management fees. It's also possible that you may only close 50 and then that's halving what you actually have. So it does differ, but I'm happy to take a look at what those specs look like and see if I can pull some comps for you.
Awesome. Next question is, do you find funds tend to be under or over invested at the end of their investment period? What is the right target to percentage of AUM at year 4 or 5?
That's a good question. There is a slide a little bit farther back that talks about the split between like initial and follow-on reserves based on the stage that you typically invest. And we will share these slides at the end. So that would be helpful for you to take a look at in terms of target for percentage of AUM around year 4 and 5. Overall, I think that really strong investment opportunities have been spaced out a little bit more in the last few years. So I would say maybe slightly under invested at the end of the investment period. And it's not necessarily for not trying. I think GPs are definitely pretty picky about their deals in general, which is great. Like you're taking your LP's money. And so I think it's wonderful that you're being selective. But I do think like it isn't necessarily all bad if you're slightly under invested on what that initial reserve is, especially if you have some potential for breakout performers that you're seeing already at the year 4 or 5 stage.
Great. From Jennifer, I've seen some models incorporate probabilities of success, which can be arranged. Do you recommend this?
I do. I think it's kind of splitting the difference of saying, hey, like if this happens, this will likely be, the outcome, but what is the likelihood of that happening? And I think it does bode to making your fund model and just reserve strategy a little bit more realistic. Nothing cracks me up more than seeing a fund model where everyone's like, I'm going to deploy 100% of committed capital and they're all going to be unicorns and winners. If that was the case, I think everyone would be in VC and I would be giving them every dollar that I have. But that's not necessarily the name of the game. So I think the probability and market comps component is definitely a good one.
Great. How do you manage fund expenses when the timeline extends beyond the typical 10-year fund life due to slower exits and fundraising cycles? Very
This
applicable to.
question I get all the time. I have not seen many funds term at the 10-year mark, at least not lately. So that being said, I would definitely check your LPA in terms of what it stipulates in terms of extension periods. I would say most commonly I see 2 1-year extension periods most often written to LPAs, but that doesn't necessarily mean that that's how yours is written. Oftentimes I encourage my GPs when we are budgeting or fund modeling to assume that this will be a 12-year fund. So that being said, you definitely want to take into consideration, 2 extra years of fund admin, 2 extra years of audit and tax. The other kicker too, and I did mention this in our budgeting webinar last year, don't forget to include estimated wind down costs. But as you're starting to approach that 10-year mark, I would be really kind of taking a health assessment of these portfolio companies and thinking through what the probable exit strategies are. And especially as you're pushing that 12-year mark, like, does it make sense to do a stock distribution? Does it make sense to actually just like do a buyback to the company or do a secondary sale if these investments are going to sit longer to like IPO or M&A? So thinking through that and definitely having discussions with your tax team, I think is helpful to help make sure that you're making the right decision for yourself and your LPs.
Do you have benchmark wind down costs for a 50 to $100 million fund or any other ranges?
Yeah, I do. I don't have them right on me. So if you want to send me a note, I can pull those for you. I would say like probably 30,000 on the low end. And this can also be really contingent on like, do you have to do a stock distribution? Do you have to pay for a broker? What are those fees looking like? You know, what's the scale of that? And in terms of actual physical legal wind down costs, legal, I'm sure, is so tired of hearing this question from me, but I will always ask them, even if it's like the first year of the fund, I'll be like, can you approximate how much you think this will cost? They'll give you a ballpark figure. I usually add 10%, just like for this budgeting exercise. But yeah, I can also pull these for you if you want to send me a note after this call.
Great. Okay. I don't think there are any more questions in the queue.
Great.
Awesome. All right. Well, as Lauren mentioned, she is available. We'll be sending a follow-up email with the recording, the slides, and then Lauren's contact information, as well as mine and Kristen's. If you want to schedule some time with Lauren, she will make herself available. If there's anything that you want to dive deeper on or anything specific to your firm or fund. So thank you everyone for joining us today, and we hope you have a great rest of your day.
Thanks, everyone.
Bye.